Major cities across the U.S. are in financial trouble.
I think we can all agree on that we're broke.
We're seeing sales tax come down, we're seeing business tax come down, and stays in our hotels come down.
One study says that 53 of the largest cities in the United States haven't generated enough revenue to cover their bills.
Clearly, there are significant capital needs, across the U.S.
Several cities spent years taking on debt to fund services, and now some public officials are reining in spending.
We've got to be careful because you don't want to get into too much debt.
Rising debt may lead to dirtier streets, fewer public services, and tough decisions from public officials that need to make ends meet.
The cities that are in trouble, they have a cash flow problem. They may be able to count on some revenue growth. Increasing taxes may be an option. Short of that, they're going to have to cut services or benefits.
Why are so many U.S. cities going broke? And what will that mean for residents of our biggest and busiest places? Running a major city is expensive. For an example, look at New York City. With over 8 million residents spread across 5 counties, it has to pay for more than most.
It's a dense, diverse place that requires a significant investment in the public realm.
Brad Lander is Comptroller of New York, the top accountant for the city. Comptrollers review every financial aspect of city government. In the case of New York, that includes over 1,700 parks, over 200 library branches, 11 acute care public hospitals, 472 subway stations, and about 177,000 affordable housing units. Like many other parts of the U.S., New York City sells municipal bonds to fund many of these projects.
The city's bonds are like your mortgage, for long-term expenditures, something that you're going to use over generally 10, 20, 30 years. You borrow for it.
Here's how it works. Investors foot the bill for the city's general obligations. The city promises to pay them back later on with interest.
We pay the interest on our bonds, but then we can use those bonds to build schools and invest in our water and sewer infrastructure and subsidize affordable housing. But then we've got to be careful because you don't want to get into too much debt.
Some experts believe that cities and state governments in the U.S. are selling bonds to spend more money than they can pay back.
In our study, we gave the city of New York an F grade.
Sheila Weinberg is the founder and CEO of Truth in Accounting, a nonprofit that says they promote transparency in public accounting.
What we found is that the city has $177 billion of debt. This represents $61,800 per taxpayer.
New York City calculates a smaller debt than the estimate from Truth in Accounting.
So right now, we've got about $96 billion of debt outstanding. Currently, the way the debt ceiling works, we could borrow up to about $125 billion. So we have $25 to $30 billion of room.
The group claims that many so-called sinkhole cities have more bond debt obligations than they're reporting publicly. They focus on underfunded pensions and retiree health benefits that are owed to public employees, but backed by investments in the stock market.
We see pension and retiree healthcare debt problems in most major cities. We also find that with the 50 states.
As of 2024, U.S. pensions are underfunded by $1.6 trillion, according to researchers at Stanford. They point out that pension contributions are invested in the stock market, then paid back to employees for the rest of their lives.
Our pension funds are fiscally sound. They're 80% funded, and we have a path to get them to be 100% funded over the next decade or so.
If public officials invest funds in stock markets and the bet goes the wrong way, it can make or break a city. For example, retiree payment obligations are part of what sent Detroit into bankruptcy in 2013. In the fallout, Detroit temporarily revised its pension program to limit payouts to former employees. This decision let the city put more money into its reserves.
Even though that's an expense that was incurred and they have that debt, it doesn't have to be included in the balanced budget requirement. If I don't pay that invoice, I don't have to include it in my balanced budget.
Truth in Accounting points out that cities like Chicago, Philadelphia, Houston, Portland, and Miami all owed more money than they held in assets in fiscal year 2022. That year, stocks sank in the worst year since the Great Recession, before recovering. As a result, cities from coast to coast have had to tamp down on spending to balance their budgets.
Mr. Mayor, hi.
Yes, how are you?
In New York, Mayor Eric Adams entered 2024 with a $7 billion budget gap. largely attributed to an increase in asylum seekers and migrants arriving in the city. He proceeded with spending cuts dubbed PEG, a program to eliminate the gap.
These actions, along with an unexpectedly strong economy, help balance fiscal year 25. But we're not out of the woods.
So what the mayor announced was a series of 3 5% cuts that add up a little shy of 15%. A lot of those cuts that are being felt very, palpably by New Yorkers.
For example, the city comptroller says funding cuts for public education will end some class offerings at the City University of New York, while increasing class sizes. Additionally, many libraries in the city are cutting their hours.
There's not one neighborhood library left that's still open 7 days a week. Obviously, if you work during the week and the weekend is when you can get there with your kids, that can be really devastating.
The mayor's budget also cut funding for programs that provide an alternative to incarceration, a policy that reduced strain on New York City's jails.
So you have to make hard choices in budgeting, but it really is important not to be penny wise and pound foolish.
The city governments of Portland, Oregon, Washington, D.C., and Los Angeles are all cutting back on spending too.
You have upward pressure on wages and downward pressure on city revenues. That creates a gap that we are facing right now that we need to fill. So we're paying for positions that are not filled and are delivering no services. That's a practice that we need to pull back on if we're going to have a balanced budget.
The Los Angeles County government sees stagnant revenue growth in 2024 and beyond, which it says will sharply limit its ability to fund existing obligations, let alone new programs. And in Portland, leaders see a fiscal cliff ahead as there are no funds left to address existing financial issues.
The demand for resources continues to surpass availability within the city.
Cities often use credit to raise money from investors in the bond market. Portland, for example, has a AAA credit rating, which could make it an enticing place to park cash.
Interest earned by owners of municipal bonds is exempt from federal taxation, which helps to lower the overall cost of borrowing for state and local government issuers.
3 major agencies grade cities on their ability to repay their debts.
So Fitch's credit rating scale, it's expressed using the categories of AAA to BBB for the investment grade category, and then from BB to D, which signifies junk or speculative grade.
Cities like Chicago can spend years in the speculative grade junk bond category. The city received an upgrade on its ratings by continuing to make advance payments toward future pension obligations.
We balanced this budget without increasing the city's base property tax. I was elected to end this government's addiction to the regressive taxation that has pushed working families to the brink, and that begins today.
I believe this is a big problem throughout the country. The voters think, they must be living within their means, and they're not. But if you can go ahead and use budgeting gimmicks and not have to raise taxes, but still provide a large amount of services and benefits, that's obviously beneficial to elected officials.
Other factors like climate change could be making public administration more expensive.
We've started in our own bond underwriting to reflect on the city's climate risk and try to be clear and transparent about it. If we're going to have coastal resiliency for protection against storms and hurricanes, if that's the new normal amidst climate change, and we do need to make investments.
The leaders of cities can sometimes rely on the federal government to bail them out, especially when crises hit.
I think during the pandemic, there was, of course, very real anxiety about whether the model that is New York City would continue to work.
New York City received an estimated $28.6 billion in federal grants during the pandemic from a wide variety of programs.
That money, even though they're claiming that those direct federal dollars went for COVID relief, that allowed them to use other money for additional spending. It kind of was a bailout for these cities and states.
Tax revenues are projected to decline in New York City in fiscal year 2024, something that's happened only 3 times in the past 4 decades.
There's real urgency, and I think people are not really appreciating that.
The city could find new revenue using old tools. Take, for example, property taxes. The average American will pay over $165,000 in property taxes over the course of their lifetimes. The rates are highest in states near the largest cities, including Metro New York, Greater Boston, and Chicago. In lieu of tax hikes, the city could raise its debt limit, as proposed by New York State's leaders, to address ongoing capital needs.
we project the city could hit that ceiling by about 2029, 4 or 5 years from now.
To the extent that, they can issue debt to finance a portion of their capital plan, that could mean, unsafe, school conditions, overcrowding, certainly roads, infrastructure, bridges, tunnels are all part of the capital plan. And so, there's risk associated, with an inability to issue debt.
The state and local governments have balanced budget requirements so they don't get unsustainable debt. I think that almost these requirements give people a false sense of security because the elected officials say year after year that the budget's balanced when they're using budgeting and accounting gimmicks to truly not balance the budget.